Hi everyone, welcome to the Property Finance Podcast, and today we're carrying on our series of frequently asked questions, and today I'm joined by Adam Powell again, who's going to be sort of talking us through what product you need if you're doing a refurb. So Adam, talk us through, if I'm going and doing a refurbishment project, what product do I need? Do I need bridging? Do I need development? What do I need?
It's an often asked question actually by our clients as to what is more appropriate. It wasn't that too long ago, a few years ago, where there was a distinct line between development finance and bridging, and over the years, recent years, I think the bridging lenders have sort of taken a look at what development lenders can do, and I've picked up most of them have picked up the model to then say, okay, well, for the sort of the refurb type deals, we can look to actually provide a facility to enable them to do the refurbishment. Because, to be honest with you, and this was a big challenge back in the day, was that some of the refurbishment deals that we were taking a look at a few years back, applying a development facility to those types of projects was a bit like taking a sledgehammer to crack a nut. I mean, there was a bit of overkill, and typically the client was then relying on their own funds to do the refurbishment. Yeah, but bridging lenders saw a gap in the market, and they wanted market share, obviously. So it wasn't just bridging they wanted to do, and a lot of them now do refurbishment bridges. So there's if you imagine a sort of a Venn diagram, they're sort of now overlapping a little bit on what some of the development lenders are doing, and it's more about scale. I think it's there is a point where, for example, if you're looking at a small conversion, for example, or putting on an extension, or converting a roof space or something like that under a refurbishment product, bridging lenders will take a look at that. Yeah. But as soon as you start scaling up onto some pretty big conversions, then it may be more appropriate that a development lender steps in, especially when you're talking about larger loan sizes and larger projects.
Yeah, and that's based on obviously their expertise as well. Development lenders are more leaning towards those larger scale ones. They've got the teams in place to deal with the larger scale developments. They've got their expertise in house to deal with the larger stuff, whereas bridging lenders have more of an expertise, probably more of a preference to that smaller stuff. But also they have two very distinct ways of releasing funds, when in fact actually probably three distinct ways of releasing funds, which I think is worth just touching on quickly because it can really affect someone's project. And I think you've got the vanilla bridging lenders who have, in quotations, decided to do refurb. But actually what they do is they do a bridge at 75% loan to value and then continue at 75%. So every time you think you've done some work, they'll then come out, revalue it, and then give you 75% of the uplift. However, the difficulty with that is, as most of us know, the start of a refurb, the main bulk of the first part of a refurb is rip out, taking everything out, stripping out. In fact, actually you diminish the value. So actually by saying we'll lend 75%, you go and do a release for 20, 30 grand, whatever it is, think you're going to get it. They come out and do the valuation.
Well, that's where
you don't get it.
That's where a lot of the, some of the bridging lenders, when they first started stepping into this marketplace, they were relying on the uplift of the value during the project, which was somewhat a recipe for the disaster, and because of that example you've just given.
But it's a curve, isn't it? You essentially, well, in fact, actually, in some instances, it's almost like an S curve, isn't it? Where you've got the value of the property as it is now, the value then drops before it then comes back up again.
Yeah, we saw some of that take place where the facility was provided and at a high loan to value, and of course the value the client goes in there. Let's say it's a commercial block that's been converted, and the developer's ripped everything out, and that's cost him some money. He now wants to release more money, but of course the value is going to go out there, value it, and it's gone down in value, so there's no room for them to actually release any more capital.
Well, and in some circumstances as well, you've also got that risk potentially of, with it being on sort of the S-curve model, is actually you've got the value of the property as it is now, the LTV is 75%, let's say for argument's sake. Actually the value drops and all of a sudden your loan to value, as the value is dropping, your loan to value is going up, and there's that point where actually the lenders are potentially at 90, potentially even 100% loan to value, because
hence some of those lenders aren't lending
no longer around. Yeah. So I think that it's worth touching on that there are still lenders that do that, and it's very important that you understand as a client when you go for refurb, development, whatever it may be, how those funds are released, because getting stuck on a product like that is catastrophic, really.
It can be, yeah. And I know that there was one example where the client literally had to fund the project for the first 5 months before the sufficient uplift in the value.
Well, it's quite again, going on that escalator, you've got to fund that entire drop, but also you've got to fund the rise again. And also you've got to fund the rise past where it was worth before to even get to a point where you can release.
So I tend to avoid those.
Yeah, well, we do, don't we? We tend to keep away from them. So in terms of development finance, then talk us through how that's normally released and kind of how people can expect to draw those funds.
With development finance on sort of like conversions and what have you, if we're staying within that sort of frame, then apart from them releasing a day one for the advance, they'll release for the purchase, they'll then release funds in tranches.
Yeah.
And you only get charged the interest on the amounts that get released.
Yeah. And there's no non-utilisation fees or anything like that as well?
No, they used to be back in the day, but there's hardly any that do that now.
Yeah.
And what they'll do is they'll get a QS to go out, and sometimes it's monthly, they'll go out and inspect the property.
Yeah.
Make sure the work's been done, check the invoices. He'll then do a report, fire that into the lender and say, right, he's done this amount of work, I've checked it, it's fine. Here's the invoices, he needs X amount.
Yeah.
And the lender will then release that next tranche of funds straight away.
And there's huge variances as well, isn't there, as to what a QS can kind of get away with and what the lender will allow, because sometimes it's QS, sometimes it's an asset manager if it's a slightly smaller project.
Yes. And I think that's where the bridging lenders really step up to the plate, because, as I said, sometimes a development lender is a bit like taking a sledgehammer to crack a nut. You will...
They'll employ a QS to come and do a small refurb, which you don't need.
Which you don't need. So you need, sometimes it could be either an asset manager or the valuer even going out and just re-inspecting the property to say the work's been done.
Yeah.
But the key thing is that it's knowing which the type of project that the client's going for, whether you're going to go to a development lender.
Finding an appropriate lender, yeah.
Or whether you're going to go to a bridging lender with their refurb products.
And also, it's not only the works they can claim back, so some lenders will allow materials, for example, if they're secured, insured, etc. on site. There are some lenders who will allow some of those materials to be claimed for as well, which can be quite good for the cash flow as well, because if you're going to Howdens or MKM or whatever, the building merchants, and you're pulling in materials obviously for use in sort of 2 or 3 months or whatever, you can still claim those back, even though you're on 30, 60-day terms with some of the merchants. So that can be quite good for the cash flow as well.
Yeah, yeah. So I think as I said before, the most important thing is knowing that going through the details of the project with the client and knowing where you're going to place it. That's the key thing.
Brilliant. Thank you very much. Thank you very much to everyone who's watched and listened. Catch you on the next one.